Everything in this video is not a financial advice. Government bonds are one of the safest and most reliable investment vehicles available. Issued by national governments, these bonds are essentially loans you make to the government in exchange for periodic interest payments and the return of your principal at maturity. While they may not offer the high returns of stocks, they are a cornerstone of conservative investing and provide stability during economic uncertainty. Here, we'll explore the benefits of investing in government bonds, the potential risks, and actionable strategies for incorporating them into your portfolio. What are government bonds? Government bonds are fixed-income securities issued by a country's government to finance its operations and projects. In the United States, for example, Treasury bonds, T-bonds, Treasury notes, T-notes, and Treasury bills, T-bills, are popular options. Other countries have similar instruments, such as UK gilts, German bonds, or Japanese government bonds, JGBs. 1. Treasury bonds, T-bonds. Long-term bonds with maturities of 10 to 30 years. 2. Treasury notes, T-notes. Medium-term bonds with maturities ranging from 2 to 10 years. 3. Treasury bills, T-bills. Short-term instruments maturing in less than a year. Benefits of investing in government bonds. 1. Safety and stability. Government bonds, especially from stable economies like the US, are considered low-risk investments. 1. They are backed by the government's ability to tax and print money, making them highly secure. 2. Predictable income. Government bonds provide a fixed interest rate, paid semi-annually or annually, offering a steady and predictable income stream. 3. Portfolio diversification. Adding government bonds to your portfolio can help reduce overall risk. 3. They often perform well during periods of market volatility or economic downturns, acting as a counterbalance to riskier assets like stocks. 4. Inflation-protected options. Some government bonds, like Treasury, inflation-protected securities, TIPS, in the US, adjust their principal value based on inflation, protecting your purchasing power. Risks of government bonds. 1. Low returns. Government bonds typically offer lower returns compared to equities or corporate bonds. 1. While they provide stability, they may not grow your wealth significantly over time. 2. Interest rate risk. Bond prices are inversely related to interest rates. 2. When interest rates rise, the value of existing bonds falls, potentially leading to capital losses if you sell before maturity. 3. Inflation risk. For non-inflation protected bonds, rising inflation can erode the real value of the fixed interest payments and the principal. Historical returns of government bonds. 1. Over the past 10 years, US Treasury bonds have delivered an average annual return of approximately 2–3%, depending on the bond's duration and market conditions. 2. Historically, long-term government bonds in the US have provided an average annual return of around 5 to 6% over several decades, though this varies with interest rate cycles and economic conditions. Actionable strategies for investing in government bonds. 1. Consider inflation-protected bonds. Add TIPS or similar instruments to your portfolio to safeguard against inflation eroding your returns. 2. Reinvest interest payments. Use the interest income from bonds to reinvest in other assets or purchase additional bonds, compounding your returns over time. 3. Use bond ETFs, exchange-traded funds, like the iShares, 20-plus year Treasury, Bond ETF, TLT, or Vanguard Total Bond Market ETF, BND, offer a convenient way to gain diversified exposure to government bonds without purchasing individual securities. Example of potential return. Let's consider an investment in a 10-year US Treasury bond with an annual yield of 3%. 1. Initial investment, $10,000. 2. Annual yield, 3%. 3. Maturity period, 10 years. At the end of 10 years, you would earn $3,000 in interest, $300 per year, and receive your $10,000 principal back, totaling $13,000. Conclusion: government bonds are an excellent choice for risk-averse investors or those seeking stable, predictable returns. While they may not deliver high growth, their safety and reliability make them a valuable component of a diversified portfolio. By strategically incorporating government bonds, diversifying across maturities, and reinvesting interest payments, you can maximize their benefits and achieve your financial goals. As always, consider your risk tolerance, investment horizon, and financial objectives when deciding how to allocate your resources. If you want to see a detailed video about bond investment, leave a comment. Please like and subscribe.